Hi, this is Scott McLeod with Brown Financial Advisory with the second part of our two-part series about the economy and is it getting worse? And I want to share with you this last bullet point of our agenda, which is what happens now? What's the current economy look like and what should we expect going forward? The first thing that I'll share with you is an NBER heat map, if you will, that describes a little bit about what's happening in the U.S. economy. So the very simplest form of this map is just to show green is going well, red is full-on recession. And you can look back here in the 2020 range and see that there is a lot of red right there at the beginning of the pandemic when the economy shut down and a lot of the indicators went negative. And then shortly following that, there's a lot of green on the graph where everything reopened and all the indices were up again, and different sectors of the economy were reporting growth, positive impact, and so forth. So if you'll just fast forward out here to 2023 and you look at the graph, the thing that seems most compelling about this part of the graph is that there is no standout color. There isn't anything that jumps out at you that says, oh my goodness, this is a really scary scenario. Look at all this red, or even on the flip side of that, look at all the green and how great things are. We're kind of in the middle. And that would actually describe that rolling recession concept that you've heard before, where during this time of contraction, we may not see the whole economy contract at once, but we may see little pockets of the economy pulling back, slowing earnings, et cetera, in various sectors of the economy, so that this describes a soft landing. In fact, if you look at the graph at the bottom of the page, you can see the change in the last 6 months, real personal income. You can see non-farm payroll, household survey of employment, real consumer spending, et cetera. And they're all modestly positive with the exception of real wholesale and retail sales, which are down slightly. This is a perfect example of what a soft landing might look like, at least at this stage in the game, where things are slowing at a relatively controlled pace, and you have most everything is positive, but you have one thing that's slightly negative, and that's an indicator that things are slowing down. But will we end up in a full-blown recession? Well, we might be in recession in the true sense of the word, which is just 2 quarters of contraction, but will it be severe? And as things are portrayed by this particular chart, it doesn't appear that things will be severe. Even if we end up in a slight recession, it might just show contraction, but not severe contraction. So it's a compelling argument that we are near the inflection point, but we may also still have a little bit of extra work to do. And all the work, of course, is surrounding the inflation rate. So what's happened over recently is we've seen that the inflation rate has dropped precipitously. So the headline CPI at one point back at the beginning of 2022 was upwards of 9%, just touched 9%. That's a scary scenario for inflation in the U.S. to be at 9%. And we've all seen prices of just about everything we know going up over the last couple of years. And so that's the whole idea behind inflation, and you have to pull it down. So, but the Fed has done a great job, I would say, in the last couple of years of bringing inflation down pretty quickly. Now, they jumped on the economy with both feet at the beginning of 22, and that's why the bond market and why the stock market sold off so much last year, and why we're still kind of digging out of that hole, if you will, that they created with that aggressive rate tightening. But we have seen inflation rates come down. In fact, now we're looking at the most recent reported headline CPI at 3.7% when the 50-year average is 3.9%. So we're actually below average right now and nearing the target that the Fed has established of 2% inflation. So if we get to 2% inflation, the Fed can feel comfortable that they can start loosening things again, and we can get back on sort of a normal track, if you will. So what does that mean? The Fed may continue tightening, and if they do continue tightening, then of course that slows the economy even further, and that's what spooked the market over the last few months. So the Fed made the announcement that they could leave the option on the table to raise rates later this year, and the stock market started selling off right away. And that, in combination with those high valuations that I mentioned before, has caused the stock market to come down and also interest rates to go up. which has negatively hurt the bond market as well. So what then is the probability that they will raise rates toward the end of the year? Well, the markets price in those probabilities, and it looks like that probability is declining. It's still significant enough to take into consideration, but the chart on the left should just tell you after the 825 meeting, the probabilities were higher than they were after the 914 meeting that they will raise rates in November. So September and December are very, very low probabilities, but it does look like there is the potential for rates to decline, to be increased in November, but the potential is declining with the most recent inflation news. So if we keep our fingers crossed and inflation continues to decline in October and then possibly going into November, we have really good inflation numbers, then the Fed may reconsider. And I think the market has priced in the possibility that they won't raise rates. In fact, if you look at the most recent year-over-year core CPI numbers, which are 3-month annualized numbers. So you take the most recent 3-month, month-over-month numbers, and what you find is the year-over-year core CPI is at 2.4%. Their target's only 2%, so we're actually within striking range of what their target is. And if we get down closer to that near the end of the year, then the Fed will be more inclined to stop raising rates and may start considering the time frame for lowering rates again. A lot of the August acceleration in inflation was as a result of energy prices, with gas prices going up. And so as a result, that contributed a lot. When you take that out, then the inflation rate actually looks quite manageable. And I think the Fed will take that into consideration. So what does that mean from an investing perspective then? And this is the most important aspect of this. So I mentioned before in the previous presentation that the bond market has not bounced at all yet. The stock market has bounced a little bit from the declines, but hasn't recovered fully. So what does that mean with regards to the outlook on the portfolio? Well, this graph shows how the valuations are across the asset classes in the portfolio. So when I say valuations, of course, what I mean is how expensive things are. And historically, the more expensive it is, the less upside potential it has. And something that's less expensive has a lot more upside potential. So what you'll notice on the graph is if you look at the graph on the left-hand side, you'll see that most of the fixed income assets are the least expensive at the moment. So the bond market has sold off a lot, as you know, for the last couple of years. And as the result, those bonds are super cheap now, giving them a lot of upside. Both treasuries, munis, and core bonds are all priced really, really inexpensively right now, giving us a lot of upside in the bond portfolio. But in addition to that, you'll also see that developed international stocks, emerging market stocks, and U.S. small company stocks are all trading below their averages. So the 25-year average valuation, they're all trading below those averages. Now, on the flip side of that, the U.S. stock market as a whole, U.S. growth stocks, and high yield stocks are all expensive. So what you'll see now, even with our nice 12% return year to date, because of the concentration of those stocks that I mentioned in the previous presentation, those stocks are concentrated in such a way that the valuations have exceeded the average, and it's pulled the average valuation of the S&P 500 up above its long-term average, the 25-year average. And therefore, it can't be considered inexpensive. In fact, you might even consider it a little bit expensive right now. Nevertheless, the vast majority of the portfolio actually looks quite compelling. And so from here, we're just waiting on the inflection point. We're waiting for the Fed to feel comfortable that inflation is low enough that they can turn things loose again. And when they do, as soon as they give any indication at all that they feel comfortable we're in a good spot and they can pause from here, the stock market will take that as a good sign that we can go forward. The bond market will also take it as a good sign we can go forward. And as the Fed begins lowering rates, we'll start to see the bounce that we're waiting for in the bond market and those potential double-digit returns that I mentioned in the previous presentation. So one of the things that I've seen recently in conversations I've had is regarding those fixed rate securities that are out there now that interest rates are so high. So short-term interest rates are very high. And that's why now we have a Schwab money market that's paying over 5%. That's why the bank CDs now are in those 6, 12, 18-month periods, upwards of 4, 5, 5.5%. So you're starting to see those fixed rate low volatility securities yielding really good rates. So the question then comes up, well, if they're that great, if the rates are that good, I can get 5.5% for a year, or I can get 5.5% for 18 months. Why wouldn't I just put my money in the 5.5% and leave it there and not have any volatility? Well, the risk in that is twofold. First of all, when you do that, you're still selling the stock market out at a low point. When you see valuations like this, first of all, and then secondarily, we've not seen the full recovery of the stock market to match where we were just a couple of years ago. And so therefore, if you're selling out for a fixed rate security, you're not selling maybe at the bottom, but you're selling certainly closer to the bottom than to the top. And so you're locking in those declines. The second thing is you may think of it in terms of the substitute for the bond market. And the problem with that is you also miss the bond market bounce. So if we've been in bonds, which we have, we've experienced a lot of the negative volatility, but we can make that volatility back up very quickly with just a small decline in interest rates. And I mentioned before that one fund hypothetical illustration showed that if we see interest rates drop 1%, which is very close to what the projected decline is for next year, then we'll see those bond funds up 13% or maybe even more, depending on how long the maturities are. So we've got double-digit potential in the bond market and good potential in the stock market too. As you know, the stock market moves very quickly, and so it just takes no time at all. It's sold off 5% or more in the last few weeks. It'll rise 5% in another few weeks. So a 5% return on a CD just doesn't really work out very well. In fact, if you look at it historically, you can have a CD that has a 5% return, and that's great historically, but it doesn't match the bounce. And this chart shows what happens typically after we see rate hiking cycles when the CD rates peak. So this is not unusual. Every time they raise interest rates, we see this peak in CD rates, and it's compelling because we haven't seen those rates in a long time. Money market rates at this rate, we haven't seen that for a long time. But in every single example here, most of the other asset classes outperform, with the exception of 2000, and that was because that was a protracted decline in the stock market after the dot-com bubble. But if you look at 1984, 1989, 1994, 2006, 2018, those examples, those all have significant outperformance in other asset classes in the 12-month period following the peak in interest rates. And why is that? That's simply because when the interest rates peak, that means they're coming back down again soon. And when they come back down, that means that you get the bounce in the bond market, you get the bounce in the stock market, and you often end up with double-digit returns across the portfolio because you see those bounces. So to think of a CD or money market yields as a substitute for investing in the bond market, investing in the high yield market, or investing in the stock market, it's not a good substitute, because that peak, even if you caught it right on the money, will pale in comparison to what happens in the stock market going forward. So with low valuations and the economy relatively healthy and inflation rates at a pretty low point, getting closer to the Fed target, you have to believe that the inflection point is not that far away. And if it is, we're probably hitting peak CD rates. And if that's the case, then this is the kind of performance that you would expect to see in the portfolio following those turnarounds in CD rates. So what's the key takeaway from all of this? The first thing that I would emphasize is that the U.S. economy is generally healthy. So we're seeing pockets of slowdowns. We're seeing the money supply kind of dry up a little bit, harder to get a mortgage. But in general, the U.S. economy is okay. Starting to see earnings trail down a little bit. It's harder to do business with the interest rates as high as they are. The Fed is slowing things down, but we're still in that soft landing scenario, not the hard landing scenario. So we're seeing pockets of contraction that still exist across the economy. However, valuations are attractive now, but we just don't know the timing. So I would say you would expect a bounce in the bonds, but when does that occur? Maybe in the next 3 months, it could be 6 months or 8 months, 9 months, a year from now. We don't know, but that means that you have to be patient as those bonds are recovering from the declines but the recovery is just about imminent because you'd have to expect that the interest rates will come back down once the Fed wants to stimulate the economy again. They don't want to keep interest rates high because they want things to be in a good balance. So the rates this high slow things down, they'll lower rates to speed things up again. So it's just a matter of time. Same thing with the stock market. You look at the valuations trading at nearly 1/2 times the first standard deviation. That just means there's an opportunity right there for the market to go up. And we see that throughout most of the portfolio with only pockets of valuations that are high. So we don't know the timing, but you have to think we're much closer to the inflection point than we've been throughout this whole process. Of course, all through 2022, the market was going down. We've seen the market come back up. We haven't quite seen the inflection point yet, but it's coming and it's not that far away. So the economic outlook, what should you do now? And I would say the very first thing is if you have free cash, so if you're sitting on cash in a checking account that's not yielding very much, you should move that to a money market. The current yields on money market funds are 5.2, 5.23, maybe even a little bit more than that as interest rates kind of creep up. So you'll see those yields. It's a good time to be in a money market right now that has a good yield like that. So we can help you get settled on that. However, don't be tempted by moving the assets to fixed rate security. So avoid that temptation. Right now, it feels really compelling because we haven't seen these rates in 10 or 15 years. I think it's probably 2007 or 8 since we've seen anything like this. And so it's really compelling. I'm loving my 5.25% money market yield for the cash that I have, but don't be confused that that's a substitute for the market, because when the market takes off, as you know, you tend to get your money very fast. It bounces really quickly, so you can't be out. You have to be fully invested during that period. The third thing is if you happen to have any of that home equity line debt that's still out there, do your best to pay that down or off now, because those yields are upwards of 8 or 9%, maybe even higher than that. If you have any other consumer type loans out there at those rates, if you can pay those off, that's an instant return on your money. So that's a good idea. That takes some of the uncertainty away from that. But home equity lines and anything else that's high interest debt, if you can pay it off, that's great. Extra cash in the money markets, and then stay fully invested. And the most important thing is just be patient during this period. The returns over time, if you look at as I mentioned in the previous presentation, the 3-year and 5-year returns, they look not great right now because we're still in the bottom of the trough. With the bounce, you'll get right back to those average returns that you saw before and be in a very, very good spot with regards to the market and your long-term performance. So things will normalize. It'll just take a little bit to get through this period. And once the Fed stops raising rates and things go back to normal, so will the average returns on the portfolio. And with the higher yields in the bond portfolio, your average returns are expected to be higher over time. So thank you very much for all the time. I appreciate the opportunity to talk with you, especially over these 2 presentations. Please let me know if you have any questions. And I want to just thank you again for the time that you've spent here. And I look forward to seeing you again soon.